Investing can be life-changing. With the right strategy, your money can grow faster than a savings account ever could. But for beginners, investing can feel like navigating a minefield. One wrong move, and you could lose a significant portion of your hard-earned money. That's why understanding common mistakes is crucial before you make your first investment. The truth is, most beginners don't fail because of the market, they fail because of their own decisions. Emotional decisions, lack of research, and ignoring fundamental principles often cost new investors more than they realize. In this video, we're going to explore 5 major mistakes beginners make and break each one down into actionable tips so you can invest smartly and avoid unnecessary losses. By the end of this video, you'll know exactly what to watch out for, how to structure your investments, and how to stay consistent even when markets get unpredictable. So, grab a notebook, because these lessons can save you thousands in the long run. Mistake 1: investing without a plan. The first mistake is jumping into investments without a clear plan. Many beginners invest because they heard about a trending stock, cryptocurrency, or mutual fund. But investing without a plan is like driving without a map. You might get somewhere, but it's likely not where you intended. A solid investment plan starts with defining your goals. Ask yourself, are you investing for retirement, buying a home, or building wealth over the next 5 years? Your timeline determines the type of investments you should choose. Next, determine your risk tolerance. Are you comfortable with volatile stocks, or would you prefer safer, slower-growing investments? Without understanding your risk tolerance, you may panic during market dips and sell at the worst time. Finally, your plan should outline how much you'll invest regularly and how you'll track progress. Even a simple spreadsheet can help you stay on course. A structured plan ensures your decisions are strategic, not impulsive. Remember, successful investing is about consistency and long-term thinking, not chasing the latest hype. Mistake 2: ignoring research. The second mistake is ignoring research. Beginners often buy stocks or cryptocurrencies based on social media recommendations or hearsay. This is risky because you may not understand the underlying asset. Research involves analyzing the fundamentals of a company, sector, or asset. Look at a company's revenue, profits, growth trends, debt, and competitive position. For mutual funds or ETFs, review past performance, fund managers, and expense ratios. Investing without research is essentially gambling. You're leaving your hard-earned money to chance, which can lead to disappointment and significant losses. Even a small amount of research can drastically improve your chances of success. Also, consider the source of your information. Avoid blindly following influencers or viral posts. Use credible sources such as financial websites, company reports, and verified news. Knowledge is power in investing. The more you know, the better decisions you'll make. Mistake 3: emotional investing. Mistake 3 is letting emotions control your decisions. Fear and greed are powerful forces that can lead investors astray. When the market is rising, many beginners become overconfident and invest more than they should, driven by greed. Conversely, during a market drop, fear can cause panic selling. Both behaviors are detrimental to long-term growth. To avoid emotional investing, set clear rules for buying and selling. For example, define stop-loss levels for stocks or determine the percentage of your portfolio in each asset class. Stick to these rules regardless of market noise. Another strategy is to automate investments. Using tools like robo-advisors or recurring contributions to ETFs can prevent impulsive decisions. Remember, successful investors react calmly to market movements and focus on long-term objectives, not daily fluctuations. Mistake 4: lack of diversification. The fourth mistake is putting all your eggs in one basket. Many beginners invest heavily in a single stock or asset they believe will perform well. While this can sometimes pay off, it's incredibly risky. Diversification is spreading your investments across different asset classes, sectors, or geographic regions. This reduces risk because a poor-performing asset will have less impact on your overall portfolio. For example, instead of investing $1,000 in one stock, split it across multiple stocks, ETFs, or bonds. This approach smooths returns and protects you from major losses. Diversification also includes mixing risk levels. Combine high-risk growth stocks with low-risk bonds or stable dividend stocks. This balance can improve returns while minimizing potential losses. Mistake 5. Ignoring fees and costs. The fifth mistake is ignoring fees. Many beginners focus only on potential returns and overlook the impact of costs. Over time, fees can significantly reduce your investment gains. Common fees include brokerage fees, fund management fees, and hidden charges in mutual funds or ETFs. Even small percentages matter over the long term due to compounding. Before investing, always check the expense ratio of funds and the commission charged for trades. Low-cost index funds and ETFs are great options for minimizing costs while still earning competitive returns. By being mindful of fees, you can retain more of your earnings and grow your wealth faster. Remember, every dollar saved in fees is a dollar that compounds over time.